I just want to get your take on the global markets, specifically the U.S. markets, with the idea of these U.S.-China trade talks. Futures are a bit muted. Surprised at all by that?
I mean, not really. I think to a certain extent, people are in this wait-and-see moment. And I think really the real, catalyst for equity markets was going off that brink from 145% tariff down to 30. That was a game changer, I think, for equity markets to rally. These trade talks a bit more nuanced about, rare earth materials. But for me, I think the big catalyst that can drive equity markets higher from here is better than expected data. I think what we kind of underestimated as a market is, A, that the fallout from growth from these tariffs has not been as large as expected. Consumers have been front-loading a lot of spending, and I think actually you're going to get data which is a little stronger come into June and July inflation, which is kind of okay. And that actually means that you get a good earnings season going into this Q2 reporting next month.
All right, so you think we have a strong earnings season, but just a question. We were talking a bit, I don't know if you heard about this, the quote-unquote taco trade, the idea that Trump always chickens out when it comes to these tariff threats and things like that. Why wouldn't the futures be higher if that trade is still in effect? Why wouldn't people think that these talks are a sign that we're going to reach a deal, which would generally be good for the equity market? Yeah.
I mean, I think, in terms of this Trump always chickens out, I think that is somewhat being reflected in the price. We're at 6,000, right,
okay.
on the S&P 500.
You're saying it's already priced in?
I think it's already priced in to a certain extent, yeah.
Let's say we're on the path towards a deal. Obviously, Howard Lutnick's now been brought into the conversation. What sector do you see as having the biggest benefit, at least in the near term, if we strike some type of deal to either extend the tariff pause or just permanently reduce the tariffs from over 100% on both sides?
Yeah. So, I mean, look, from the tariff perspective, deals there, the biggest beneficiary is China. The consumer sector specifically. The consumer sector really has been the area that's got pinched from that. They have the biggest import exposure from China. The other one would be tech, right? Apple, Nvidia all have large exposure to the China market. So I think that's an area where a trade deal would provide a lot of relief for the tech sector as well at this point.
Yeah, speaking of Apple, their Worldwide Developers Conference coming up today. We just highlighted earlier, shares are negative year to date. A lot of pressure on this company to come up with some AI developments. And of course, a trade deal would help them with their iPhone business. I want to talk about emerging markets. So you and I, we talked a little bit before the show. China's your #1 emerging market.
Yeah.
And specifically, if there's a trade deal, I think you'd be even more bullish on China.
100%.
Outside of China, where else do you see the beneficiaries of a possible trade deal? Would it be India? Would it be, Vietnam? Would it be Brazil? Who else benefits?
So I think India has been a market which is, I would say, is more defensive at this point. Their exposure to the US in terms of their revenue exposure is very low at 5%. So a lot of people are seeing them as basically sheltered. I think actually a surprise market which could do very well this year is Mexico, where I actually think they're probably a beneficiary long-term from these trade tensions and this rejigging of supply chains away from Asia towards America. We saw during Trump's first term that actually the market share of Mexico in US imports increased 300 basis points. And this is a market that trades on 12 times earnings. It used to be on 19 times. A lot of the bad news, I think, is already reflected in the price here.
So we got granular. I want to go a bit broader. I'm looking at the EEM ETF. It's the iShares MSCI Emerging Markets ETF. Mexico's in there, India's in there, China's in there. Has outperformed the S&P if you go back to April 8th. Does that continue? And if so, is it because of a softer dollar? Like, if we're looking for signs of strength or weakness in that trade, what's the factor that creates the strength or weakness?
I think there's a number of factors here. One, the softer dollar is a key support. The other one is valuations. There's a 50% discount to US equities. The other factor is a potential trade deal. And the fourth is stimulus that's still coming out of China. I think we completely underestimate the fact that China has tried to offset these trade headwinds through large-scale fiscal stimulus. Their consumer is sitting on $22 trillion of cash. And if any of that gets deployed towards the equity market, it's a big catalyst at this moment. The final thing, which I think is key for emerging markets, is that if you look at foreign money and where's that been going, it's all been going to Europe. Almost $40 billion has been dragged out of emerging markets this year, and we're seeing tentative signs of that money coming back in. And if that continues, I think that's a real propellant for the EM markets.
So it's been outflows of emerging markets. Okay, I think a lot of us thought it was the other way around. It was money going into emerging markets.
Money's been going out of emerging markets from foreign investors, but it's really been going into Europe. So the rotation has been out of the US and into Europe, and that's why I think EM can start to play a bit of catch-up here.